All right, let's do it. Let's dive deep into financial statements. We're cracking open Financial Intelligence Revised Edition.
Oh, a classic.
It is by Karen Berman and Joe Knight. And, think of this like our crash course
Mm-hmm.
in how to actually read and understand and interpret these documents that
Yeah.
honestly can be pretty intimidating.
You can't be.
And by the end of this deep dive, you're going to have the knowledge to ask the right questions and make some, smarter decisions.
Yeah, it's about really empowering yourself
Yeah.
to see beyond just the surface level, to really understand a business's performance.
Exactly. And they start off strong with this idea of like the art of finance,
Right.
which is so interesting because it's making this argument that financial statements aren't just these objective figures.
No.
They involve assumptions and judgments.
And that's where it gets fascinating, because
Yeah.
even unintentionally, there can be bias baked into these assumptions.
Right.
And they give this example of Xerox where they were manipulating accounting to hide problems.
Oh, wow.
Not through outright fraud, but presenting a more favorable picture, right?
Yeah.
Than reality.
Well, that's a little unsettling, right? Like,
It is.
makes you wonder how much you can trust
Yeah.
these statements.
Well, it underscores that you need to do your own critical analysis, right?
Mm-hmm.
You need to understand the underlying decisions
Yeah.
that shape the numbers.
Right.
I mean, even something as simple as how a company classifies an office supply purchase
Oh, okay.
can have a significant impact on its reported profits. Remember the WorldCom scandal?
Oh, right. Yeah.
They inflated profits by categorizing regular expenses as capital expenditures.
Right.
So
And that's where things get kind of tricky.
it does.
They also talk about these accruals, right?
Mm-hmm.
And they use an example of allocating an employee's salary,
Uh-huh.
like to product development versus product cost. So how could that seemingly small decision have this like ripple effect?
Well, think about it. If you allocate more of that salary to development,
Okay.
it could make the whole process seem more expensive, right?
Mm-hmm.
Which could potentially discourage future investment in product development.
Oh, I see.
On the other hand, if you allocate it to the cost of goods sold,
Yeah.
it could impact pricing,
Mhm.
hiring, even the long-term product strategy.
So a seemingly minor accounting choice could actually like influence a company's entire trajectory.
Yeah, absolutely.
It's wild.
It's not just about crunching numbers.
Yeah.
It's about understanding the strategic implications behind those numbers.
Right.
And that leads us to,
Yeah.
those accounting principles that seem to mystify everyone, right?
Oh, yeah.
GAAP,
Yeah.
generally accepted accounting principles.
Okay.
Now think of GAAP as guidelines, not strict rules.
Okay.
And that leaves room for interpretation, which again
Yeah.
emphasizes the art aspect of finance.
So there's this human element
Yeah, there is.
to these seemingly objective
There is.
financial statements.
Yeah.
And one of the things that I find super intriguing is this concept of materiality.
Mm-hmm.
So accountants are required to disclose anything significant enough to influence an informed investor's decision, right? Even if it's not directly related to the company's performance.
Correct. Like Apple's footnote about potential legal losses, right?
Oh, yeah. Okay.
Might not directly be relevant to their current performance.
Yeah.
But it could impact future profitability.
Yeah. Yeah.
And investors need that transparency.
Yeah.
Okay, so let's get into it. The income statement, which is like the business report card,
Yeah.
it tells us how they did
Mm-hmm.
over a specific period of time.
Right. Okay.
And really focusing on revenues,
Mm-hmm.
costs, and profits.
Okay.
Now, it's important to distinguish between what we call actual and pro forma income statements.
Okay. So actual is
Actual is what really happened.
Oh.
Pro forma is often used for projections
okay.
or to exclude certain items.
So it's kind of like a what if.
Exactly.
Okay, got it.
So when it comes to revenues, things get a little interesting with this concept of revenue recognition.
Okay.
It's about when a company can actually record a sale.
Okay.
So for example, let's think about an airline ticket.
Mm-hmm.
You pay for it weeks in advance,
Right.
but the airline only records the revenue when you actually take the flight.
So until then, it's
considered deferred revenue,
oh, okay. Right.
and it actually sits on the balance sheet as a liability
Interesting.
until that service is delivered.
Okay.
Now, on the expense side,
Okay.
we've got two main categories: cost of goods sold, AOGS, and operating expenses.
Mm-hmm.
And how those expenses are classified, just like with revenue recognition, can significantly impact reported profitability.
Right.
And that's where it gets, we see that art coming into play.
It sounds like a lot of these classifications are subject to interpretation and judgment.
They are.
Yeah.
And that's why it's important to dig deeper and look beyond those surface numbers.
Right.
Now, one area that often trips people up
Yeah.
is non-cash expenses,
Oh, okay.
like depreciation.
Right.
So let's say a company buys a delivery truck.
Okay.
They pay cash up front, but that expense is spread out over the truck's useful life.
Oh, okay.
So even though they're not physically paying out cash every month for that depreciation, it's still recorded as an expense.
Got it.
And that impacts the company's perceived profitability.
Okay, so we've got expenses, then we go down to...
Then we get to the all-important
profit.
Right. And there are 3 different kinds of profit.
Okay.
Gross profit, operating profit, and net profit.
What's the difference between those?
Think of them as steps.
Okay.
Gross profit looks at the direct costs of making a product or service.
Okay.
Operating profit includes those operating expenses like salaries and marketing. And net profit is the final profit after all expenses are deducted, including taxes and interest.
Got it. So it's like layers.
Exactly.
Okay.
It's important to look at all 3, not just the bottom line.
Right.
And remember, all sorts of things can impact profitability.
Yeah.
Even external factors.
Like what?
Like currency exchange rates, right?
Oh, okay.
Especially in the global economy.
Yeah.
I mean, think about a U.S. manufacturer that's selling machines in Hong Kong.
Right. The
exchange rate fluctuations can have a huge impact
on their profitability.
And their bottom line,
So even if they're doing everything right internally,
exactly,
there are these other things that they just can't control.
Right. And that brings us to the balance sheet.
Okay, the balance sheet, yeah.
Yeah.
Which is like, it's a snapshot in time, right?
It's a snapshot.
It's like a photograph
of the company's financial position at a specific point in time.
Okay.
Showing us what they own, what they owe, and what's left for the owners.
So assets, liabilities, and equity.
You got it. And it's all based on that fundamental accounting equation. Yeah. Assets equals liabilities plus equity.
Right. And the book does this really cool analogy.
I love this analogy.
Where they compare profit to like an individual grade that you would receive in college.
Okay.
And equity to your cumulative GPA, right?
Yeah.
So one grade affects your overall GPA, just like the income statement's profit or loss affects the balance sheet's equity.
That's right. You're all connected.
Consistent profitability leads to a strong equity position.
Yeah.
Just like good grades boost your GPA.
So let's break down the balance sheet a little bit.
Okay.
First up, assets. What exactly are assets?
Assets are what a company owns that have value, and we can categorize them as current, meaning they can be converted to cash quickly, or long-term, meaning they're held for longer periods.
Okay.
So cash obviously is a current asset.
Right.
What about something like inventory?
Yeah, inventory is a current asset, right? For most companies, yeah. It represents the value of raw materials, work in process, and finished goods.
Okay.
And then you've got things like property, plant, and equipment. The things that are used in the company's operations.
Yeah.
That are expected to last for more than a year.
What about intangible assets?
Good point.
Like patents, copyrights, things like that?
Yeah, intangible assets, they don't have a physical form.
Right.
But they still hold value.
Right.
And goodwill is a particularly interesting one.
Goodwill, yeah.
It represents the value of a company's brand, their customer relationships, their reputation.
So all the stuff that isn't necessarily something you can...
Beyond their tangible assets.
Yeah.
And this is where things can get a little bit subjective.
Yeah. Goodwill is subjective, right?
It is.
And I feel like I've read about companies, trying to inflate their goodwill to make their performance look better.
You're right. Goodwill is subjective, and it can be manipulated.
Right.
And that's another area where the art of finance really comes into play.
Okay, let's move on to liabilities.
The liabilities.
Which are what a company owes.
Yes, what they owe.
And they can be current or long-term, right?
That's correct. So current liabilities are debts that are due within a year.
Okay.
While long-term liabilities extend beyond a year.
Got it.
Accounts payable money owed to suppliers.
Okay.
That's a common current liability. And then long-term liabilities often involve borrowing money, right?
Yeah.
Like loans and bonds.
Yeah.
Which companies use to invest in their growth.
And then there's accrued expenses.
Accrued expenses.
Which I always get a little confused about.
Yeah.
What exactly are those?
Accrued expenses are expenses that have been incurred but not yet paid.
Oh.
Think of payroll.
Okay.
Your October paycheck
Yeah.
covers work you did in September.
Right.
So the company has to account for that expense in September, even though the cash isn't paid until October.
Yeah.
It's about accurately reflecting the company's financial position at any given time.
So finally, equity.
Liquidity.
This is kind of what's left over.
Yeah, the residual.
After liabilities are subtracted from assets.
Exactly. Equity can come from investments by the owners, what we call paid-in capital,
Okay.
or retained earnings, which are the profits that a company keeps
Okay.
and reinvests.
So that's how the income statement
There it is.
and balance sheet kind of connect again.
They're all linked.
Yeah.
A profitable company will see its equity grow over time.
This is so insightful. I feel like I'm becoming more financially intelligent already.
That's what we want.
Yeah.
All right, now let's move on to the third key financial statement.
Okay.
The cash flow statement. And this one is arguably the most important
Okay.
because it focuses on the lifeblood of any business.
Cash.
Cash.
And they make this really, they hammer this home.
Yes, they do.
That profit does not equal cash.
No, it does not.
A company can be profitable and still run out of cash.
Exactly, if they don't manage their working capital well.
Oh, interesting.
And they use two scenarios to illustrate this. Sweet Dreams and Fine Apparel.
Okay. And so?
Sweet Dreams is profitable, but ends up short on cash.
No.
Because it grows too quickly. And it can't keep up with working capital needs.
Oh, wow.
Fine Apparel has plenty of cash, but it's unprofitable.
Interesting.
Because it's selling inventory at a loss.
So you really have to look at both.
You got to look at both.
To get the whole picture.
You got it. Now, the cash flow statement breaks down cash flow into three sections.
Okay.
Operating activities.
Okay.
That's cash from your core business operations.
Okay.
Then investing activities. Buying and selling long-term assets like equipment.
Okay.
And then financing activities.
Okay.
Transactions with investors and creditors.
Got it.
Like issuing stock or taking out loans.
So even if you're not profitable through your core operations,
Right.
you could be bringing in cash.
You can bring in cash.
Through other means.
Through financing.
Okay.
Now, the book also emphasizes free cash flow.
Yeah, yeah.
Which is the cash left over after a company pays its operating expenses and capital expenditures.
Got it.
And this gives a company flexibility to invest in growth, pay off debt, or return value to shareholders.
Right.
They even mention a Fortune 100 company that ran out of cash, even though it was profitable.
Wow.
So this underscores that cash flow management is crucial regardless of a company's size or profitability.
All right, so now we've got these three statements down.
Okay.
But there's another tool that can help us analyze a company's performance.
Financial ratio.
I always get intimidated by ratios.
Yeah, they can seem a bit complex.
Yeah.
But there's simply a way to compare different items in the financial statements to gain deeper insights into a company's performance and spot trends.
Right.
Think of it like this. Ratios help us see the story behind the numbers.
Okay, I'm starting to see how they could be useful.
All right, go
What
ahead.
kind of ratios are out there?
Well, we've got a bunch.
Yeah.
Some of the most common are profitability ratios, liquidity ratios, and leverage ratios.
Okay.
We'll unpack each of these in our next segment.
Sounds good. Looking forward to it.
Yeah.
All right, so let's untangle these financial ratios.
Okay.
We left off talking about profitability ratios, which, as the name suggests, they measure a company's ability to actually generate profit.
Exactly. And some of the key ones are gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity.
Okay.
Let's start with gross profit margin.
Okay.
It tells us what percentage of revenue remains as profit.
Okay.
After deducting the direct cost of production, also known as cost of goods sold.
So, if a company has a gross profit margin of 30%, that means they keep 30 cents of profit for every dollar of revenue after covering those production costs.
That's right.
And what can we learn by comparing gross profit margins across different companies?
Well, that's where it gets really interesting.
Okay.
A company with a higher gross profit margin than its competitors might have a competitive advantage, such as lower production costs or the ability to charge higher prices.
Makes sense. So on to operating profit margin.
Operating profit margin.
How's that different?
Well, operating profit margin takes into account not just the direct costs of goods sold, but also all those day-to-day operating expenses like salaries, rent, marketing,
Right.
administrative costs.
Okay.
It gives us a broader picture of a company's profitability.
Right, from its core operation.
From its core operations.
Yeah. Yeah, it's so interesting to think about how all these, like, seemingly minor accounting choices can really impact a company's perceived profitability.
They do.
Yeah.
Absolutely.
And again, as with gross profit margin,
Right.
comparing operating profit margins between companies can reveal a lot.
It can.
Yeah.
About their efficiency
Right.
and their competitive positioning.
You really see, like, how well they're managing those overhead costs.
Yeah.
You got it. Okay, and then we have net profit margin.
Net profit margin.
And this is kind of the final...
The bottom line. After all expenses, including taxes and interest, have been deducted.
So that's like the ultimate profitability measure.
That's what many consider the bottom line.
Okay.
It shows how much profit a company keeps for every dollar of revenue.
Yeah.
After all expenses are paid.
It's essential to consider all three types.
You have to gross, operating, and net.
Right.
To get that comprehensive view.
To get the whole story.
The whole picture.
Okay, so moving on from profit margins, the book also talks about return on assets.
ROA.
ROA, yeah. What's that all about?
So ROA measures how efficiently a company is using its assets to generate profit.
Okay.
It's calculated by dividing net income by total assets.
Okay.
So, for example, an ROA of 10% means the company generated 10 cents of profit.
Okay.
For every dollar of assets.
So a higher ROA suggests that they're using their assets more effectively.
More efficiently.
To generate profits.
Yeah.
The example that they gave about, like, you know, a manufacturing company that has lots of equipment.
Yes.
Their ROA will tell us how well they're using all that equipment to actually make money.
That's right.
Okay, what about return on equity?
ROE.
ROE, yeah.
Now, ROE focuses on the return generated for shareholders.
Okay.
So it measures how much profit a company makes for every dollar invested by its owners.
Okay.
And it's calculated by dividing net income by shareholder equity.
So it's really a measure for investors.
It is.
Yeah.
It's a key indicator of how well a company is managing its resources to generate returns for its owners.
And this ties back into, like, that whole concept of shareholder value.
Absolutely.
Right.
Investors want to see a good return on their investment.
Yeah, exactly.
And ROE is a critical factor in evaluating a company's performance and its potential for future growth.
Investors are always looking for those companies that can deliver those strong and consistent returns.
Absolutely, they are.
Okay, so we've covered those profitability ratios.
Okay.
Let's move on to liquidity ratios.
Liquidity ratios.
These are the ones that tell us, you know, can a company pay its bills?
Exactly. Can they meet their short-term obligations?
Yeah.
So liquidity ratios help us assess whether a company has enough readily available assets to cover its short-term liabilities.
Right.
One of the most common is the current ratio, which compares a company's current assets, things like cash, accounts receivable, inventory, to its current liabilities, those due within a year.
So if a company has a current ratio of 2, it means they have twice as many current assets as current liabilities. So that's pretty good, right?
It's a good sign.
They've got a nice little cushion.
It suggests they have enough liquid assets to meet those short-term debt obligations.
What if the current ratio is less than 1?
That's a red flag.
Okay.
It might indicate that the company could struggle to pay its bills on time.
Oh, wow.
Which could signal a potential cash flow problem.
Yeah, that's something investors would want to be aware of.
Absolutely.
Okay, so then what about the quick ratio?
A quick ratio.
How is that different from the current ratio?
It's similar, but it excludes inventory from current assets.
Okay.
Because inventory can sometimes be hard to sell quickly.
Right.
So the quick ratio gives us a more conservative view of a company's ability to cover its short-term obligations.
So it's kind of like that worst case scenario test.
Exactly.
Like if they couldn't rely on selling inventory.
That's right.
To pay their immediate bills.
It tells us how well they could do with just their most liquid assets.
Okay, that makes sense. And then there's DSO.
Days sales outstanding.
Days sales outstanding, yeah.
Measures the average number of days it takes a company to collect payment after a sale is made.
Right.
So in other words, it tells us how quickly customers are paying their bills.
So a lower DSO is better?
Generally, yes.
Sorry.
Because it means customers are paying faster.
Yeah.
Which is good for cash flow.
It's good for cash flow, yeah.
A lower DSO generally indicates efficient collection processes.
Oh, okay.
Effective credit policies.
And a high DSO could mean that they're having trouble.
It could.
Yeah.
Either because they're extending credit to risky customers.
Oh, okay.
Or their collection processes are just inefficient.
And that's going to hurt their cash flow. It's wild how much you can really learn about a company's...
You can.
Yeah, like internal operations just from these ratios.
When to end their operations.
Yeah.
Now, let's talk about leverage ratio.
Okay, leverage ratios. So these are the ones that tell us how much debt a company is using.
Exactly. They help us assess the financial risk related to debt.
Okay.
The debt-to-equity ratio is a common one.
Okay.
It compares a company's total debt to its shareholder equity.
Okay.
So a debt-to-equity ratio of 1 means they have an equal amount of debt and equity.
Is a high debt-to-equity ratio always a bad thing?
It depends.
Okay.
Debt can be a valuable tool for growth.
Okay.
Because it allows companies to leverage their resources and invest in expansion or acquisitions.
So it can be a good thing.
It can be.
Okay.
But too much debt can be risky.
Okay.
Especially if profits decline. And they struggle to make those interest payments.
Yeah. Could lead to bankruptcy.
In extreme cases, yes.
So it's a balance.
It's a balancing act.
Yeah.
Now, the interest coverage ratio
helps
us evaluate a company's ability to manage its debt.
Okay.
It measures how many times over a company's operating profit can cover its interest expense.
So a higher interest coverage ratio, the better?
Generally, yes.
Yeah.
It means they have a larger safety net
to
handle those interest payments.
Okay.
Even if profits take a dip.
Got it. Okay, so now we've got profitability, liquidity, leverage.
Yep.
But there are these other ratios that like investors often talk about. Things like market cap.
Market capitalization.
Yeah, and PE ratio.
Price to earnings.
So what are those all about?
So market capitalization, or market cap, is simply the total market value of a company's outstanding shares.
Okay.
And you calculate it by multiplying the current stock price by the number of shares outstanding.
So basically, a company with a higher market cap is worth more than one with a lower market cap.
Market cap is often used to categorize companies by size.
Okay.
We talk about large cap, mid cap, small cap companies.
That's in their market cap.
Exactly.
Okay.
Now, the price to earnings ratio, or PE ratio, compares a company's stock price to its earnings per share.
Okay.
So it tells us how much investors are willing to pay for each dollar of earnings.
So a higher PE ratio means investors are like more optimistic.
It suggests that they're more optimistic
about the company's future growth.
About the company's future growth prospects.
And they're willing to pay a premium.
They are.
Yeah.
Companies with high growth expectations often have higher PE ratios.
Okay, got it.
Conversely, companies with slower growth expectations, or those facing challenges, tend to have lower PE ratios.
Okay, so all these ratios provide all these valuable insights.
They do.
Yeah.
Into a company's performance.
It's important to remember that they're just tools.
Tools, not a crystal ball. You need to consider the context, the industry, the specific circumstances of the company, and many other factors when using ratios.
It's about, like, seeing the bigger picture.
Exactly.
And understanding the story behind the numbers.
The story behind the numbers.
Not just the ratios themselves.
Not just the numbers in isolation.
Okay, now, beyond analyzing individual companies, the book digs into this concept.
Yes.
That's really crucial for understanding how businesses manage their cash flow.
That's right.
The time value of money.
The time value of money.
So what is that all about?
Well, the time value of money essentially means that a dollar today is worth more than a dollar in the future.
Okay, yeah, that makes sense.
Because money can be invested and earn a return over time.
So a dollar today has more, like, earning potential.
Earning power.
Than a dollar you get later.
Exactly.
Okay, so the book talks about
future value.
Future value.
And present value.
Future value and present value. What are those?
All right, so future value is what a given amount of cash will be worth in the future when invested at a specific interest rate.
Okay.
So, for example, if you invest $100 today at a 5% annual interest rate, in a year, it'll be worth $105.
Right.
That $105 is the future value of your $100 investment.
So it's like projecting how your money will grow.
Exactly, thanks to the power of compounding.
Okay, what about present value?
Present value is the opposite.
Okay.
It tells us how much a future amount of money is worth today,
Okay.
given a specific interest rate or discount rates.
Okay.
So, for instance, if you're promised $105 in a year
Okay.
and the discount rate is 5%, the present value of that $105 is $100.
So you're kind of discounting it back.
Discounting it back
to today's dollars.
to today's dollars.
Why is that important for businesses?
Well, present value is crucial for making investment decisions.
Okay.
Let's say a company is considering a project that will generate, say, $1 million in cash flow 5 years from now.
Okay.
To decide if that project is worth doing, they need to calculate the present value of that $1 million.
Using an appropriate discount rate.
Using an appropriate discount rate.
So they can compare that present value to the cost of the project today to see if it's worth it.
If the present value of that future cash flow outweighs the project's cost today, it might be a good investment.
Right.
Otherwise, it might be better to pass.
Makes sense, but these calculations, they really rely on like making assumptions about future cash flows.
They do.
Yeah.
And choosing the right discount rate.
So it's not always.
There's no foolproof formula.
Yeah.
It requires judgment, analysis.
It's that art of finance.
It is.
Yeah. Absolutely.
They also introduced this concept of required rate of return.
Or hurdle rate.
Hurdle rate, yeah.
Yeah.
So what's that?
Think of the required rate of return as the minimum return. Okay.
That an investor or company expects to earn from an investment.
Before they'll commit their capital.
Before they commit their capital.
So like a company might set a hurdle rate of 10%.
Right.
And they won't do a project.
Unless they expect at least a 10% return.
Got it.
And that hurdle rate can vary depending on the riskiness of the investment,
the
company's cost of capital, and other available investment opportunities.
So it's kind of like setting the bar for what's acceptable.
For what level of return justifies taking on that risk.
Right. Okay. One of the examples that they gave for using these present value calculations is in capital budgeting. Capital budgeting. Which is the process of deciding whether to invest in like long-term assets.
Long-term assets.
Like new equipment.
New equipment, facilities.
Facilities, yeah.
That's a big area where these concepts come into play.
And it can really impact the company's performance.
Absolutely.
So they talked about 3 different methods that companies use for evaluating capital expenditures.
So we have the payback method.
Okay.
The net present value, or NPV method.
Okay.
And the internal rate of return, or IRR method.
Okay, so let's start with the payback method.
Payback method is the simplest of the 3.
Okay.
And focuses on how long it takes for an investment to generate enough cash flow to cover its initial cost.
Okay, so if a project costs, say, $100,000 and it's expected to generate $25,000 in cash flow each year, the payback period would be 4 years.
4 years.
So it's really just like, how long does it take to recoup that initial investment?
Exactly. It's a quick and dirty way to assess the time to recover your investment.
But it doesn't take into account the time value of money.
It doesn't. And it doesn't consider those cash flows that might occur after the payback period.
It's just like a very basic
evaluation tool.
Okay. So then what about net present value?
NPV.
NPV. Yeah.
The NPV method.
How is that different?
Now, NPV takes the time value of money into account.
Okay.
So it calculates the present value of all future cash flows from a project, both inflows and outflows.
Okay.
And then subtracts the initial investment cost.
Okay.
So if the NPV is positive, it means the project's expected to generate more value than it costs.
Right.
Taking into account the time value of money.
So it's a much more comprehensive,
a more sophisticated approach. A higher NPV generally indicates a more attractive investment opportunity.
Okay, so then IRR.
Internal rate of return.
Internal rate of return,
IRR.
How's that one work?
The IRR method calculates the discount rate that makes the NPV of a project equal to 0.
Oh, okay. So it's like finding the break-even.
Exactly.
A discount rate.
Where the present value of future cash flows equals the initial investment.
Okay, so if the IRR is higher than the company's hurdle rate, it means the project might be a good investment.
It suggests it might be a worthwhile investment.
Yeah.
It means it's expected to generate a return that exceeds the company's minimum acceptable return.
So all of these are, they're tools to evaluate these expenditures.
And they provide different perspectives on the same decision.
But they also make the point that it's not just about the numbers.
It's not just about plugging numbers into formula.
Right, it's about the judgment.
It's about understanding the nuances of the business, making informed assumptions,
right,
considering the strategic implications of those investments.
And they also really highlighted the difference between profit and cash flow.
Absolutely.
Yeah.
It's easy to get caught up in projected profit.
Right.
But cash flow is what actually keeps a business running.
Yeah, exactly.
A project can look profitable on paper,
right,
but still require substantial cash outlays.
Especially for things like working capital.
Exactly. And speaking of working capital.
What is working capital?
Working capital represents the resources that a company needs for its day-to-day operations.
So it's like the money they need.
It's the difference between current assets, like cash, accounts receivable, and inventory, and current liabilities,
right,
like accounts payable.
It's like the fuel
it is
to keep the business going.
To keep the engine running.
Yeah. Yeah, and the book even devotes a whole section to this.
Yes.
The magic of managing the balance sheet.
The magic of managing the balance sheet.
I love that. I mean, it sounds like it's really all about how companies can optimize their financial performance by managing their working capital more effectively.
It's about managing that flow of cash.
Right.
Through the business.
All right, let's dig into this magic of managing the balance sheet and how it all ties back to working capital.
Okay, so
that fuel that keeps a business running, right?
It is.
The cash they need for daily operations.
Right. So working capital comes straight from the balance sheet.
Yeah.
It's that cash, inventory receivables, minus what they owe in the short term.
Right.
And the book really emphasizes how managing this well can significantly impact a company's cash flow and overall health.
Yeah. They break down working capital into these stages of the production cycle, starting with, buying raw materials, which triggers the accounts payable period.
Right, because now they owe their suppliers.
Right. Then, of course, they use those materials to actually make the finished goods, which is the inventory period.
The inventory period.
And then once those goods are sold,
we
enter the accounts receivable period.
Right, they're waiting to get paid.
Yeah, so it's this, constant cycle, right?
It is this constant cycle.
From buying to selling to collecting.
Buying, selling, collecting.
And the goal is to make it as efficient as possible.
Yes.
Okay, so let's start with accounts receivable.
Go.
We talked about DSO earlier.
Days sales outstanding.
Days sales outstanding, yeah.
How long it takes to get paid.
Right, how quickly customers pay their bills.
Right.
And the faster they collect, the less working capital is tied up.
That's right, less tied up in receivables.
Right, but what's really interesting is that they point out how different departments can actually influence DSO.
Yes.
It's not just a finance team.
It's a team effort.
Responsibility, right?
Yeah.
Give me some examples.
So the sales team can negotiate better payment terms up front.
Okay.
Or focus on those customers that have really good credit histories.
Yeah.
Customer service plays a role. Right.
Oh, right.
Because happy customers tend to pay more promptly.
They do?
Even the billing department can impact this.
How so?
Sending out accurate invoices quickly.
Oh,
can speed up that collection process.
So it's really about
collaboration across the organization.
To keep that cash flow moving.
To keep the cash flowing.
What about inventory?
Inventory? How can companies optimize that?
Yeah, inventory management's always a balancing act.
Yeah.
You need enough to meet customer demand, but you don't want excess inventory just sitting around.
Right. You don't want it to
tying up cash and potentially becoming obsolete.
Yeah, too much is just as bad as too little.
Exactly, and too little can lead to stockouts.
Yeah.
And missed sales. Yeah.
Now, the book mentions lean manufacturing as a way to kind of reduce inventory levels without sacrificing customer service.
Okay.
So it's about eliminating waste and streamlining production.
It's wild to think that, even the design of a product can affect inventory levels.
Absolutely.
Yeah.
I mean, if engineers can design products that are easier to manufacture, that can really simplify inventory management.
Okay, and what about the production department? What's their role?
They play a huge role.
Yeah.
Optimizing production schedules.
Okay.
Minimizing downtime.
Right.
Using techniques like just-in-time manufacturing to reduce that work-in-process inventory.
So
it's a team effort.
Yeah.
We're seeing that theme again.
Yeah. Okay, let's talk about accounts payable.
Accounts payable, all right?
The flip side.
Yeah, what the company owes to its suppliers.
So the key here
is balancing that cash conservation.
Okay.
with maintaining those good relationships
Yeah.
with your suppliers.
Because you want to pay them as late as possible.
Right.
But
you don't want to damage the relationship
right.
or risk your credit terms.
Yeah, yeah.
It is a delicate balance.
The book raises an interesting point, though, about like the ethics of delaying payments to suppliers.
It's a tricky question.
Yeah.
Delaying payments obviously puts pressure on your suppliers,
Yeah.
especially those smaller businesses.
Right.
And it can harm a company's reputation.
Yeah.
But on the other hand, negotiating favorable payment terms is a perfectly legitimate part of managing cash flow.
It's a tough one.
It is.
Seems like open communication with the suppliers would be really key.
It's all about communication, transparency.
Yeah.
Building those strong relationships.
Right. So you've got these three key areas: receivables, inventory, payables.
And the book brings it all together.
Yeah.
With this concept called the cash conversion cycle.
Okay, the cash conversion cycle?
Yes.
What is that exactly?
So it measures how long it takes for a company to convert their investments in inventory and other resources into cash flow from sales.
Okay.
Essentially, it's how efficiently are they managing that entire cycle.
Yeah.
So a shorter cash conversion cycle is better.
Makes sense.
Because it means that cash is being generated more quickly.
Yeah. So the formula is DSO plus days in inventory.
Plus days in inventory.
Minus days payable outstanding.
Minus days payable outstanding.
Got it. So you can really monitor this.
Yes. And that can help companies spot areas for improvement in their working capital management.
This has been amazing. It's incredible how much you can learn about a company.
It is.
Just by looking at how they manage.
And that's why the book calls it the magic of the balance sheet. It's understanding that flow and making strategic decisions.
To optimize it.
Yes.
Okay, so we've covered so much in this deep dive.
We've gone through the art of finance, financial statements, ratios, working capital.
The importance of working capital.
All of it.
But I think, one of the big takeaways from the book is just the overall importance of financial literacy.
Absolutely.
Why is that so crucial?
Well, because when employees understand the financials, they can make better decisions, right?
Yeah.
That actually support the company's goals.
Right.
They can see how their actions directly impact the bottom line or the cash flow.
And they'll be more likely to.
And they're more likely to act in the best interest of the business as a whole.
Absolutely.
And it can also really boost morale and engagement, right?
Oh, yeah, I bet.
When people understand how their work contributes to the bigger picture, it's more motivating.
It's more motivating.
Now, the book even links increased financial literacy to better corporate performance.
Really?
Studies have shown a correlation with improved profitability, productivity, even stock performance.
Makes sense. Everyone's speaking the same language.
Everyone's on the same page.
Working towards the same financial goals.
Yeah.
It just makes everything run more smoothly.
It creates a more aligned and effective organization.
Yeah. So what are some of the things that companies can do?
Well, the book suggests a few ways to promote financial literacy, from formal training programs to more informal things like, lunch and learn.
Right.
And they really emphasize financial transparency, it being open about the company's performance, explaining how decisions are made.
It builds trust, right?
It does. It creates a culture of openness.
Yeah. This has been really, really enlightening.
It has.
Yeah. I feel like I've learned a lot. And it's given me a much better understanding of how businesses...
It's been my pleasure diving into these concepts with you.
They leave us with a pretty thought-provoking question.
They do.
What if everyone had a basic understanding...
What if everyone...
of finance?
Yeah.
How would that change decision-making?
It would transform things.
Yeah.
Imagine a world where everyone, from the CEO to the frontline employees... could understand these financial statements and make decisions that align
with the company's financial goals.
Absolutely.
It's an inspiring vision.
It is.
I'm definitely inspired to keep learning.
Keep learning.
Yeah, and keep exploring.
That's what it's all about.
This world of finance,
It's fascinating stuff.
Well, thanks for joining me.
Thanks for having me.
On this deep dive.
It's been fun.
And until next time.